We keep talking about the big run-up that we've had in equity markets, but actually, U.S. equities have been in quite a range for the past month. The big run-up sort of went from the March low to the beginning of June. It really sort of shows how it's difficult to kind of gauge where we go directionally from here. J.P. Morgan's Kalanovich convinced the S&P 500 can get to another record. His reasoning that investors might start to reallocate from bonds into stocks. Is that something that you see happening towards the end of the year as well?
I think so. You know, we've seen, as you said, this big run up and something of a pause as you know, the markets were already pricing in quite a rosy economic picture, and now you kind of feel that economic picture needs to unfold. Interestingly, it is. We are seeing so far pretty much a V-shaped recovery. I think one of the big tests that is coming up is going to be the Q2 earnings season, and whether it is as bad as expected, worse than expected, or actually surprises on the upside like a lot of the economic data has in the last month or so. But I think as you move forward into the end of the year, if we can, you know, sort of contain this virus even better, because a lot of regions have done a relatively good job at managing the reopening, I think stock markets will rise into the end of the year.
So, Esty, I need to know. Great, hurrah! I hope we do. But you're cautious, and volatility is going to rise. I need to know: do you want equity volatility as a hedge, or do you want bond volatility as a hedge on your disappointment risk? So, vol question first.
I'd say on the equity side, because your bonds have been very well behaved. Central banks are pouring so much stimulus, and I expect bonds to remain much better behaved. I think you mentioned some of the risks just earlier coming into the end of the year, questions about the U.S. election, what's priced in or not, what that might look like by October. A little bit more volatility is expected in the equity markets.
Yeah, so let's talk about the election then, Esty, because Goldman's warning investors to hedge for a U.S. elections delay. They say that with the virus and more mail-in voting, that adds to the risk for murky results. And then, really interestingly, RBC Capital Markets did a survey between June 15th and 22nd, which said investors were more worried about the election than a second wave of coronavirus cases. J.P. Morgan, though, says that actually investors are mispricing the risk too much to the downside on a Biden win. How do you expect investors to... Well, actually, let me put the question this way. Do you expect election risk to actually trump COVID risk in the autumn?
That's a difficult question to answer right now. I think the COVID risk at the moment, it's about lockdown, it's about a second confinement, it's about shutting down economies. And to me, today, that does not seem likely. Now, things could deteriorate a lot further, but I think it would take so much for governments to choose to shut down their economies again. As you move towards the election, I think there's this view that people on a I'd say personally, have issues with President Trump. So, but at the same time, that taxes are going to go up if Biden wins. And the question is, what is really priced in there? But frankly, I don't think the U.S. election in itself could derail the equity rally entirely. As I said, I think volatility can come up, and I think there's going to be, reactions as we get closer, as, it looks more likely that one or the other is going to win. But I don't think either of those actually is going to stall the rally completely.